Bitcoin is the best in class for digital assets. It's got by far the biggest network effect, the most security, the most simple and robust design, the best kind of uh, structure to maintain its long-term decentralization. I mean, I think all these trends support both Bitcoin and gold. I've been long both for many years, and you might want to consider replacing some of your equities with Bitcoin.
With its unmatched network security, simplicity, and decentralized robustness, Bitcoin outclasses all other crypto contenders. Alden challenges conventional portfolio thinking by suggesting a transformation of the traditional 60-40 allocation. Instead of holding low-yielding sovereign bonds and overvalued equities, she recommends replacing bonds with gold for stability and equities with Bitcoin for asymmetric upside. As macroeconomic pressures mount, currency debasement, geopolitical risk, and sovereign debt spirals, scarce assets like Bitcoin become essential stores of value. Bitcoin isn't just digital gold. It's a technological breakthrough in monetary design, with unparalleled network effects and resistance to dilution. Alden's view is clear. In a world increasingly defined by volatility and systemic fragility, owning the best-in-class scarce asset, Bitcoin, isn't speculation, it's prudence.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
I think all these trends support both Bitcoin and gold. I've been long both for many years. The way I generally phrase it is if you start with a 60-40 portfolio, you might want to consider replacing some of your bonds with gold, and you might want to consider replacing some of your equities with Bitcoin. Because you're talking about different levels of volatility of the assets, and that's so far been a great trade. Bitcoin's outperformed most equities. And gold's generally been much better to hold than most bonds, especially sovereign bonds, over 5+ years and counting. Longer term, depending on what starting point you want to go with. But basically, I think this is an environment where you continue to want to own scarce assets, and notably want to hold scarce assets that are the best in class for whatever it is that they do, and that they're not getting diluted in market share by other things. So if you own equities, you want to own the best ones at reasonable prices. If you want to own, crypto, you want to own the best and biggest self-sustaining network effect, in my opinion. I view it as it's a useful addition to the instruments that people have to own dollars. I've been on the record as being bullish on the amount of stablecoins proliferating since early 2021. Meaning that it's not really an investable trade because unless you're the issuer. Because stablecoins are pegged to a dollar, but they have market implications globally. One way to think about it is that for decades, wealthy people had access to offshore bank accounts. And this is relevant in a world of, 180 different currencies, most of which debase very quickly and pegs break and inflation happens and authoritarian governments can seize assets. So all these kind of wealthy entities could have offshore bank accounts, and stablecoins are basically offshore bank accounts for the middle and working class. It uses technology to compress the overhead. And it makes it easier to access custodial dollars and also use them as basically a checking account in dollars for those that don't have access to American banks or other developed market banks like Europe, Canada, these types of places. And so, Africa has 40+ currencies. Imagine all the cross-border frictions of trying to trade. Latin America has something like 30+ currencies. Again, all the cross-border frictions. Most of the currencies don't retain their value for very long. And so stablecoins are a way to access dollars globally. They basically digitize part of the Eurodollar market. So I don't really view them as necessarily adding fragility, nor do I view them as a panacea for funding the government treasury. Though I guess the one caveat I would add is that as we see a little bit of top-down de-dollarization, meaning that, say, foreign central banks are not holding treasuries and buying treasuries at the rate that they used to, you still don't generally see any bottom-up de-dollarization. So people in a developing country, if they want to hold a fiat currency for 3 months or 6 months for working capital, it'll generally be the dollar. And the stable coins allow a little bit more buying pressure because they can access them easier than they can access potentially other dollar instruments.
Alden explains how Bitcoin and stablecoins are redefining global access to financial systems. While stablecoins aren't investment assets, they are digital infrastructure, bridging underserved populations with access to US dollars. In regions like Africa and Latin America, where local currencies rapidly debase, stablecoins act as modern offshore accounts for the masses. This accelerates global dollarization from the bottom up, even as central banks begin de-dollarizing from the top. Meanwhile, Bitcoin continues to outperform equities and gold over multi-year timeframes, delivering higher returns and offering trustless portability. Unlike Ethereum, which faces structural uncertainties and competing priorities, Bitcoin maintains a fixed monetary policy, unmatched decentralization, and regulatory clarity. Alden sees Bitcoin as institutionally sufficient for corporate balance sheets and ETF structures. In contrast, Ethereum's complexity and unknown future supply weaken its case as a long-term holding. Her thesis is clear. Bitcoin is the foundational digital asset. Everything else is either speculative or transitional.
I don't think that this cycle is over yet. So I think we're going higher this cycle. I don't know if that means 150,000. I don't know if that means 200,000. I wouldn't try to guess. At any given time, I'll assess market conditions, levels of euphoria, warning signs, or bullish signs. I'm still not too concerned with the end of this cycle. I generally continue to much prefer Bitcoin over Ethereum. I've generally made the case that while I'm bullish on Bitcoin and stablecoins, I'm not really bullish on other crypto assets, including Ethereum. At times it can have a bull run in a trade and play catch up. But in general, because Ethereum's kind of stuck in the middle ground where it's not as viewed as being decentralized and secure and risk minimized as Bitcoin. It has this additional complexity. It has changing monetary policy. We don't really know how many ETH are going to exist in 5 years. Could be more or less than we expect. On the other hand, there are other networks that optimize more for scalability. And so Ethereum kind of finds itself in the middle ground of trying to justify itself as a long-term holding while also trying to compete with some of these faster networks that care even less about decentralization. And so I think it's best to stick to the best-in-class one, which is Bitcoin. I think that's the one that's institutionally sufficient to put in, major corporations and build ETFs around. But that doesn't mean that others won't have their time in the sun temporarily. I just think that long term, I'm not particularly bullish on the ETH BTC ratio. And my view is more like, if you just bought a small slice of it, you could generally forget about it forever, because if it does keep going up, you're protected because you own it. And if you end up being, if the bears are right and it diminishes greatly in value, you've only kind of wasted 5% of your exposure on it. And I generally view that as a healthier strategy for owning these assets. I mean, like I said, I've been long gold and Bitcoin for many years, and it makes it really easy to, you don't lose sleep over it, because you have the physical surety of gold, which is always nice. There's a market for that. The downside is it's not very portable, and Bitcoin is this growing network effect, new communication protocol of value. It's got even less supply growth than gold. It's got self-reinforcing network effects. You can send it to people very easily. Like if you were to hold a QR code up on this call, I could give you Bitcoin. I can't give you gold in any sort of direct way without credit. And so they're two different asset classes, or two different assets that kind of compete for similar but not identical markets. And I think they're both valuable.
For Alden, the strategic advantage of Bitcoin lies in its combination of monetary clarity, technical security, and growing adoption as a neutral global value protocol. While gold offers physical permanence, Bitcoin transcends borders, offering instant final settlement with less supply dilution and greater scalability. In a world of fiscal irresponsibility, rising inflation, and centralized overreach, both assets have merit. But Bitcoin's digital nature and self-reinforcing network effects make it uniquely suited for the 21st century. Her long-term strategy emphasizes simplicity. Hold a small, secure allocation of Bitcoin, allowing exposure to massive potential upside without risking overexposure. This approach minimizes emotional investing and maximizes macro resilience. As the monetary system transforms and trust in fiat diminishes, Alden's thesis urges both individuals and institutions to act with foresight. Don't wait for crisis. Position in the world's most scarce, secure, and decentralized monetary network today. That network is Bitcoin.